Welcome to This Week This Morning, the weekly video that gets you up to speed on the week's most important developments for your business and your taxes. Astute viewers will recognize that it's been about a month since our last episode, and well, a lot has happened. Most of it centers around a growing target on the upper middle class and wealthy, as well as corporations in the form of increased taxes and audits. Let's face it, with all of the federal spending going on right now, the government needs revenues, and they know that they're not going to get it from the 95%. So they're going after the 5%, who comprise about 37% of the gross income reported to the IRS each year, which is believed to be an understated, or rather underreported figure, which drives a significant amount of the United States tax gap, which is currently estimated to be greater than $1 trillion by IRS Commissioner Charles Rettig. Hence, more audits. It was inevitable with a Democratic administration that felt compelled to raise taxes to pay for unprecedented spending over the past year and spending yet to come. So I'm going to give you a list of things that have developed over the last month that you should absolutely be aware of if you're an affluent individual and or a business owner. Number one, the IRS is getting substantial funding to double their workforce over the next decade in a push to raise $700 billion from audits and other enforcement over the same time period. That would put them at about 180,000 employees. Currently, the likelihood that you have been audited for your 2019 tax return is about 1 in 650, although that number will go up because the statute of limitations is still open for that year. For the most recently closed tax year, however, that rate was about 1 out of 175. Audit rates are going to go way up for those with more opaque sources of income, aka income other than W-2 or 1099, as the IRS estimates that 72% of the misreporting comes from those with more complicated tax returns. The bottom line is that you've got to have your I's dotted and your T's crossed now more than ever before. Number two, the IRS has updated its guidance on how employers will claim tax credits for the COBRA premiums that they're being mandated to pay for certain departed employees. The credit is claimed on Form 941, which is the quarterly payroll tax return. If you have a payroll company that will work with you on this, you can actually retain withholding taxes in anticipation of claiming the tax credit. Number three, and this one I'm kind of happy about, somewhat selfishly, there is a push to regulate tax preparers that are not CPAs, EAs, or tax attorneys. In general, if you're using an unlicensed preparer, you should just do the return yourself. If it's too complicated to do yourself, then you should use a licensed preparer. You can check if they are licensed easily through a Google search. Unlicensed preparers, quite honestly, give the tax prep industry a bad name. Don't be lured into a low fee. They don't charge much because they're largely incompetent. Harsh, but true. Number four, cryptocurrency transfers worth over $10,000 will be required to be reported to the IRS, likely starting for tax year 2021. Number five, the step up in basis for those who inherit assets from the deceased is under attack. Current law allows the beneficiary to inherit the asset with a tax basis of the fair market value at or around the date of death. The current push is to make it so the basis remains what it was in the hands of the deceased, aka much lower. This would create a much larger tax bill when the asset is eventually sold. Number six, the current belief is that higher capital gains taxes and the other increases in taxes for those making over $400K, which I've talked at length about before, will go into effect in 2022, but we should have more clarity next week when Biden releases his budget for the government's upcoming fiscal year. This will happen on May 27th. Some of those increased taxes could easily go into effect for 21, so don't sleep on this. Number seven, the Restaurant Revitalization Fund will stop accepting applications this coming Monday, the 24th, and the Paycheck Protection Program has run out of funding. Number eight, Treasury Secretary Janet Yellen has proposed a 15% global minimum tax in order to prevent U.S. companies from offshoring their profits to more favorable tax jurisdictions. So yeah, a lot is on the table here. As I've said before, the importance of tax planning in the here and now and over at least the next couple of years will be crucially important because a lot of these changes are ticking time bombs, and the taxes you'll pay if you're caught holding the bag are going to be much more painful than they used to be. That's all for now. See you next week. For real this time.